Hey everyone, welcome back to Corporate Decoder, the place where we dissect the inner workings of big business. Today we are diving deep into Reynolds Consumer Products' latest annual report, and let me tell you, this report is packed with enough numbers to make your head spin, but we're here to unravel it all. Their story this year is one of steady sales, but with some interesting shifts and challenges that we need to pay close attention to. Before we start, if you want more of these simplified financial breakdowns, make sure you are subscribed. Also, if you are looking for a place to discuss these insights and connect with other finance enthusiasts, join our Discord community. The link is in the description below. Alright, let's jump right into what Reynolds Consumer Products Inc. has been up to. This is their annual report, the big one, covering their entire fiscal year ending the 31st of December 2025. They're reporting a big jump in total net revenues compared to last year, an increase of $26 million, or about 1%, bringing their total net revenues to $721 million. That might not sound like a huge leap, but when you are talking about billions, every little bit counts. This increase was mostly thanks to higher prices, which means they passed on some of the rising costs of making their products to their customers. However, they did see a dip in sales volume in their retail business, meaning people bought fewer of their products overall, even if they paid a bit more for them. Now let's talk about costs. Their cost of sales went up by $90 million or 3% to a whopping $807 million. This rise is mainly because it's costing them more to get their raw materials, to manufacture everything, and to ship it out. This is a common theme we see across many companies right now, with higher input costs eating into profits. And that brings us to gross profit. After accounting for the cost of making their products, Reynolds Consumer Products made $914 million in gross profit. That is actually a decrease of $64 million, or 7%. From the previous year, this drop in gross profit, despite higher revenues, really highlights how much those rising costs are impacting their bottom line. On the brighter side, their selling, general, and administrative expenses actually went down by $47 million, coming in at $382 million. This is good news because it shows they're managing their operational costs more efficiently, likely by cutting back on advertising and personnel costs. All of this leads to their income from operations, which is the profit they make from their core business activities. For 2025, this figure stands at $492 million. This is a decrease of $57 million or 10% compared to the prior year. So while revenues grew slightly, those higher costs and reduced operating efficiencies squeeze their operational profits. And after all expenses, taxes, and interest payments are factored in, their net income for the year was $301 million. This is a notable drop of $51 million, or 14% from 2024. This clearly shows that the increasing costs and the dip in sales volume have had a significant impact on their overall profitability. Now, they also present something called Adjusted EBITDA, which is a way for them to measure their performance without some specific costs. Adjusted EBITDA for 2025 was $667 million, a slight decrease of $11 million or 2% from the previous year. This non-GAAP measure also reflects the pressure from lower retail volume and higher material costs, even though they managed to offset some of that with higher prices and reduced selling expenses. Let's dive into their segments. The Reynolds Cooking and Baking segment, which includes things like aluminum foil and parchment paper, saw its revenue increase by 4%, reaching $259 million. This growth was driven by higher prices and more sales outside of the retail market, like to other businesses. Their adjusted EBITDA here also saw a small increase, which is positive. The hefty waste and storage segment, think trash bags and food storage bags, also had a good year, with revenues growing 3% to $111 million, thanks to higher sales volume. Their adjusted EBITDA saw a small bump too, indicating a healthy performance for this segment. However, the hefty tableware segment, which includes disposable plates and cups, experienced a significant revenue decrease of 9%, falling to $850 million. This drop is primarily due to lower sales volume, especially for their foam products. Their adjusted EBITDA also declined, showing this segment is facing some headwinds. This likely ties back to the growing concerns about single-use plastics and environmental regulations affecting these types of products. And finally, the Presto product segment, which focuses on store brand versions of bags and wraps, saw revenues increase by 5% to $628 million, mainly due to higher volume, but their adjusted EBITDA remained flat, suggesting that while they're selling more, their costs associated with scaling up this business are keeping profits from growing. Looking at the product line specifically, cooking products brought in $259 million, waste products $936 million, tableware $850 million, and storage products $681 million. It is interesting to see that tableware revenue decreased significantly compared to last year, while storage products increased. This aligns with the segment performance we just discussed. When we look at their balance sheet, their accounts receivable, net stands at $355 million for 2025, a slight increase from $337 million last year. This means customers owe them a bit more money, which is often a sign of increasing sales, but it also means they need to manage collections closely. Their inventories are up a bit to $584 million. This could mean they are stocking up in anticipation of higher future sales, or it could signal that some products are not moving as quickly as they would like. Given the slight dip in sales volume we saw earlier, this is something to keep an eye on. And then there is goodwill sitting at a massive one, $895 million. Goodwill on a balance sheet represents the premium paid over the fair value of net assets when a company acquires another business. It means Reynolds has a lot invested in acquisitions, and the value of these acquisitions remains stable, according to their latest assessment. Now for the debt, their long-term debt is a hefty one, $580 million. This is down from $686 million last year, which is a positive sign as they paid down some of their debt. They also recently refinanced their term loan facility, which changed its maturity date and some payment terms. Let's look at cash flow. Net cash provided by operating activities decreased slightly to $477 million. This reflects the lower net income we talked about. They are still generating good cash from their day-to-day business, but it is a bit less than last year. Investing activities used $161 million, which is an increase from $120 million last year. This mostly means they spent more money on capital expenditures, which are investments in things like new equipment and facilities. That is generally a good sign that they are reinvesting in their business for the future. Financing activities used $306 million, a bit less than the $346 million used last year. This category includes things like paying down debt and paying dividends to shareholders. They did make a big voluntary payment of $100 million on their term loan. Speaking of dividends, they paid out $192 million in dividends to shareholders. They intend to continue this practice, which is good for investors, but it also means less cash is available for other business investments or debt reduction. Now, let's talk about the risks. Reynolds Consumer Products Inc. is very clear about the challenges they face. A big one is their reliance on relationships with major customers. 3 customers alone accounted for 31%, 17%, and 11% of their total revenue in 2025. Losing even one of these could really hurt them. They also point to competition and pricing pressures as major concerns, with companies like Clorox and C. Johnson being their rivals. And like many companies, they're worried about labor shortages and rising labor costs. This means it is harder and more expensive to find and keep employees, which can slow down production and increase expenses. They are also subject to a lot of regulations, especially since many of their products are used with food. Environmental regulations are a growing concern, particularly around single-use plastics. They mentioned that new laws and bans on certain products could limit what they can sell and increase their costs. This is a critical area for them, especially with the hefty tableware segment showing declines. And of course, the debt. They have over $2 billion in outstanding debt. While they are paying it down and have refinanced some of it, this is still a significant financial obligation that could limit their flexibility and expose them to interest rate risks. Finally, they are acutely aware of cybersecurity threats. They describe their ongoing efforts to protect their systems and data, acknowledging that any major breach could have serious consequences for their business and reputation. So, what is the story here? Reynolds Consumer Products is navigating a complex economic environment. They've managed to grow their revenues by increasing prices, but this has come at the cost of lower sales volume in some areas, particularly their tableware business. Their core cooking and storage product lines are performing more steadily. The company is investing in its future through capital expenditures, but carries a significant debt load. Key risks revolve around customer concentration, competitive pressures, rising costs, and evolving environmental regulations. Overall, Reynolds Consumer Products appears to be a stable company with strong brands, but they are facing significant pressures from rising costs and changing consumer preferences. Especially around sustainability, their ability to manage these challenges, innovate in line with consumer demands, and continue to diversify their customer base will be crucial for their future success. That is our deep dive into Reynolds Consumer Products annual report. What are your thoughts on these numbers and what they mean for the company's future? Let us know in the comments below if you found this analysis valuable. Please hit that like button, it really helps us out. And of course, subscribe for more insights from the corporate world. Don't forget to join our Discord community for further discussion. Thanks for watching, and we'll see you in the next video.